In 2025, SpaceX reported a net loss of $4.937 billion. The year before, it made $791 million in profit. In the 12 months between those two numbers, something specific happened. It is documented in the S-1 filing that SpaceX submitted to the United States Securities and Exchange Commission on May 20, 2026. The filing is a public record. It runs to hundreds of pages. It contains the answer. In June 2026, SpaceX is attempting to list on the Nasdaq at a valuation of $1.77 trillion. That would make it the largest initial public offering in the history of financial markets. More than Alibaba, more than Saudi Aramco, the biggest ever. At $135 per share, SpaceX would be valued at 94 times its 2025 revenue. A company that lost nearly $5 billion last year is asking the public to value it more highly than almost every other company on Earth. The paper trail exists. Most people never followed it. If that interests you, subscribe, because this channel covers what most people slept through. Part 1. Context. To understand what is on record, you need to understand what SpaceX was before the filing. Elon Musk founded Space Exploration Technologies, SpaceX, in 2002. He invested $100 million from the sale of PayPal. The idea was to reduce the cost of a rocket launch by 90%. At the time, a single launch to orbit cost between $100 million and $250 million. The commercial launch market was controlled by established defense contractors. No startup had ever broken in. The first 3 launches of SpaceX's Falcon 1 rocket failed. By 2008, the company had burned through nearly all of its capital. No operational revenue, no commercial customers, no successful orbital flight. Then the United States government intervened. In 2006, before SpaceX had reached orbit even once, NASA awarded the company a $278 million contract to develop cargo delivery capabilities for the International Space Station. That contract was unusual. SpaceX was unproven, but NASA made the bet anyway. In late 2008, within months of SpaceX's first successful orbital launch, NASA followed with a $1.6 billion contract. That money kept the company alive. Over the following 15 years, according to government records and SpaceX's own filings, the company received more than $13 billion from NASA, more than $5 billion from the Department of Defense. In 2020, the Federal Communications Commission awarded SpaceX nearly $900 million in federal subsidies to support Starlink's rural broadband rollout. A Washington Post analysis found that Elon Musk's business empire has received at least $38 billion in government contracts, loans, subsidies, and tax credits. By 2025, SpaceX had become the dominant force in American orbital launch. Its Falcon 9 rocket had completed more than 300 missions. Its Starlink satellite internet service, a constellation of satellites in low Earth orbit providing broadband access, had crossed 10 million subscribers and generated $11.4 billion in revenue in 2025 alone. That single business unit posted $4.4 billion in operating profit. In 2024, SpaceX as a whole made $791 million in net income. It was profitable. It was dominant. It was privately valued in a December 2025 tender offer at roughly $1.1 trillion. Then 2025 happened. Part 2. The Hidden Truth. The S-1 filing divides SpaceX's business into 3 segments: launch, connectivity, and AI. The launch segment covers rocket launches, commercial satellites, government payloads, NASA crew rotations to the International Space Station. In 2025, the U.S. government paid SpaceX $5.9 billion. NASA, the Department of Defense, and American intelligence agencies are listed on record as the largest customers. The connectivity segment primarily Starlink, is profitable. In 2025, it generated $11.4 billion in revenue and $4.4 billion in operating income. The AI segment is not profitable. According to the S1, SpaceX's AI division generated $3.2 billion in revenue in 2025. It posted a $6.355 billion operating loss. At one segment alone wiped out the profits from every other part of the business, and then some. It is the documented explanation for why a company that made $791 million in 2024 lost $4.937 billion in 2025. Then, in February 2026, 3 months before the public IPO filing, Elon Musk merged SpaceX with xAI, his personal artificial intelligence company. The combined entity was renamed SpaceX AI. The deal was structured as an all-stock transaction. No independent investment bank was hired to assess whether the price was fair to existing SpaceX shareholders. The transaction was reviewed and approved by a board over which Musk holds 82.4% of combined voting power. This structure is not a conclusion. It is a disclosure. It is in the filing. Under the dual-class share structure, Musk's Class B shares carry 10 votes each. Class A shares, the ones being sold to the public, carry 1 vote each. After the IPO, Musk will continue to hold approximately 82.4% of combined voting power while owning a smaller share of the economic equity. Under NASDAQ rules, a company with this level of concentrated control qualifies as a controlled company. A controlled company is exempt from certain governance requirements that apply to all other public listings. It does not need a majority independent board. It does not need independent compensation or nominating committees. SpaceX, as a public company, will have fewer governance protections than a standard listed firm. Part 3. The covered public narrative around SpaceX's IPO has been written almost entirely in superlatives. $1.77 trillion valuation, the largest IPO in history. The 7th biggest company in the United States, larger than Tesla, larger than Berkshire Hathaway. A company that builds rockets, owns satellite internet, and now stands at the frontier of artificial intelligence. The roadshow launched on June 4, 2026. Institutional investors were presented with a vision: SpaceX as the infrastructure layer of human civilization in space. Reusable rockets, satellite internet for the unconnected world, AI systems orbiting the Earth, processing data at speeds ground-based infrastructure cannot match. Financial media covered it as a generational investment opportunity. Coverage focused on Starlink's subscriber growth, on Falcon 9's launch record, on Starship's potential to carry cargo to the moon and beyond. The xAI merger received less sustained attention. When it was reported, the deal was framed as a strategic combination: rockets plus AI, hardware plus software, vertical integration. The word synergies appeared frequently. The phrase Musk's vision appeared more frequently still. The S1's disclosure that the AI segment lost $6.355 billion in 2025, more than SpaceX earned in its best years, received coverage, but not the kind that slows a roadshow. The 94x revenue multiple was noted. It was compared favorably to early Amazon and early Nvidia. What was less often reported: Amazon was not simultaneously losing billions in one of its own founders' separate ventures when it went public. Nvidia did not carry a governance structure that exempted it from standard board independence rules. Those are facts. They are in the filing. The prospectus is a public document. The information is there. Most people read the headline. Part 4. The consequences. The consequence of this IPO, if it lists as filed, is straightforward. Ordinary investors will own shares in SpaceX. They will not control it. Under the dual-class structure, Public shareholders, regardless of how many shares they hold, cannot elect or remove a majority of the board. They cannot vote down a related party transaction of the kind that produced the XAI merger. They cannot force management change. They cannot close a division that loses money. This is not unprecedented in American markets. Meta has a dual-class structure. Alphabet does. But the concentration of voting power at SpaceX is documented as higher than both. The AI business that merged into SpaceX AI posted $6.355 billion in operating losses in 2025. Those losses are now consolidated into the public company's accounts. Public shareholders absorb those losses proportionally. They have no vote to exit the AI business, no vote to replace the strategy, no recourse beyond selling the shares. The $75 billion raised in the IPO will be used in part to continue building AI infrastructure. That is stated in the use of proceeds section of the S1. The valuation of $1.77 trillion assumes the AI business will eventually turn profitable. At its current operating trajectory, $6.355 billion in losses against $3.2 billion in revenue. That is not a near-term projection. It is a bet being made, in part, with public capital. There is precedent for scrutiny of this structure. In 2016, Tesla acquired SolarCity, a solar company also controlled by Musk, in a deal shareholders later challenged in court. The Delaware Court of Chancery ruled in 2022 the acquisition was entirely fair. But the litigation itself produced documented evidence of the degree to which related party transactions in Musk-controlled companies require careful examination. The SolarCity case is a public record. SpaceX's S1 is a public record. The pattern is documented. Part 5. What it means today. This is the reason the SpaceX IPO matters beyond the headline numbers. Starlink is already the dominant satellite internet provider in rural America. It operates in Ukraine. It connects remote communities on every continent. It was built, in significant part, with federal subsidies. The company is now applying for a share of $42 billion in additional federal rural broadband grants through the Commerce Department. The company receiving those grants will soon be publicly traded. The founder who built it using government capital will retain 82.4% of its voting power after the IPO. The public investors who buy the shares will fund the continued operation of a loss-making AI division and have no vote on what happens next. This is not a conspiracy. Every line of it is in the public record. The S1 filing raises a question it does not answer. Who does a public SpaceX actually serve? Its shareholders? Its government customers? Its founder? The filing documents a company built on public money, substantially altered by an internal merger, and now offered to the market at a valuation that has no historical precedent. The governance structure ensures that whatever happens next, the decision will not be made by the people who bought the shares. That structure is not hidden. It is disclosed in the language of financial regulation across hundreds of pages of a document filed with the United States Securities and Exchange Commission. The paper trail exists. Most people slept through this. You didn't. Subscribe, because there's more.